easy to switch back and forth between hawkish and dovish?
No, I think the message from my point of view is that the normalization process in the United States is coming to an end. On rates, we've already raised rates about 225 basis points from where they were initially. On the balance sheet, we've got that decision hopefully coming up in the next couple of meetings. So I think we're in a good place today. We've had a lot of success, and people said it couldn't be done. We got the interest rate back up. We got the balance sheet, reserves are down 40% from where they were. There are a lot of technical issues around the balance sheet, which we can talk about this morning. But basically, I think we're in a very good place today. We've got this muted inflation, no urgency for action. I think we're data dependent going forward.
Is it time to start talking about tapering yet?
Not yet. We're not thinking about shrinking the balance sheet. Just to be clear, I just want to make sure that that's out there. We're not even thinking about raising rates. When the time comes to raise interest rates, we'll certainly do that. And that time, by the way, is no time soon.
I guess since I'm first, I'll go ahead and re-up Howard's question from the last press conference. Is it time to start talking about tapering yet? Have you and your colleagues had any conversations to those effect? Thanks.
Thank you. So, no, it is not time yet. We've said that we would let the public know when it is time to have that conversation, and we'd said we'd do that well in advance of any actual decision to taper our asset purchases, and we will do so. And inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now.
Hey, Jim, I just want to try and figure out where you are in relation to the rest of the FOMC. I know that the majority of the dots are now looking for 2 rate hikes in 2023, but there are some people who are looking for rate hikes in 2022. Where do you kind of come down? Where's your dot?
Yeah, I put us starting in late 2022. 2022.
All right. Today is Sunday, June 20th. This is a recap for the stock market activities last week and an outlook for this upcoming week. Here's a reminder of the state of the stock market since the financial crisis. The government and the Federal Reserve enacted emergency intervention to recover the stock market and the economy right after the financial crisis. Part of that was the quantitative easing policy unleashed by the Federal Reserve in the form of slashing interest rates lower and keeping them that way for as long as possible, in addition to the assets purchasing programs by the Federal Reserve, aka the cocaine operation. When the Federal Reserve buys bonds across the yield curve, but specifically in the longer end of the yield curve, it creates the TINA argument. What is the TINA argument? There is no alternative. You can't buy bonds fighting the Fed because, remember, buying bonds push the prices of bonds higher, but in turn, it pushes yields lower. Now, bonds investors usually buy bonds as a safe investment form for the long term to capture yields in 10, 20, and even 30 years from now. But if the Federal Reserve continues to buy bonds pushing yields lower, then that would be a dumb investment, wouldn't it? And therefore, you have no alternative but to buy and invest in the stock market regardless of valuations. And this has been the story of the stock market since the financial crisis, meaning that Wall Street has been benefiting from emergency policies enacted to curb the risk right after the financial crisis over 10 years ago, and these policies are still here. In 2018 and 19, the economy started to get hot again, and there was the discussion whether the Fed should start to tighten the monetary policy by pulling back on these emergency policies intended to recover the market right after the financial crisis. And in 2018, as the Fed started to raise interest rates to normalize the market because we have a hot economy, a hot stock market, and these emergency policies are not needed anymore. The market threw a tantrum in the form of a market crash, and you all remember the market crash of 2018. The Federal Reserve came out right away and said, okay, we hear you, Wall Street, the rich, and corporate America, and we're going to stop raising interest rates once again. What do you know, in 2019, the economy started to get hotter again, and the stock market started to rise impulsively higher. And in the beginning, the first quarter of 2020, we started to have the discussion once again. Are these policies needed anymore because the economy is getting hotter, the stock market is reaching all-time highs after all-time highs after all-time highs, and inflation is starting to show up? What do you know? February 2020, we got the COVID-19 crisis, and Wall Street, the rich, and corporate America had the biggest orgasm they've ever had since the financial crisis, because now they have an excuse to keep these emergency policies and even add to them. And we saw the tsunami of liquidity, the bailouts, the stimulus here and there, the Federal Reserve enacting lending programs all over the place to Wall Street, buying bonds from Apple, the richest company in the world, and pushing those emergency policies intended to recover the market right after the financial crisis on overdrive. Okay, we all understood that that was needed. The economy had a harsh shutdown. We're facing a pandemic that we have not faced in over 100 years. Perhaps that is justified. But we now know that the Federal Reserve and the federal government overdone the liquidity tsunami and these rescue policies. And now we're facing inflation once again. And the economy is recovering. It's getting hotter. Wages are increasing. Savings rates are excellent. Consumers are paying their credit cards. Corporate America is flushed with cash. We're seeing a massive bubble overtaking the economy and the stock market. Equity prices, all-time highs. Housing prices mirroring the same conditions we saw back in 2006 and 2007, heading into the financial crisis and the housing crash. And therefore, we're having the same discussion all over again. Is it time for the Federal Reserve to start to tighten the monetary policy and normalize the economy? Because these emergency measures are not needed anymore. And if the Fed continues on the path of enacting these policies and keeping these policies, inflation will get out of control, and we will see another crash in the equities and housing markets. The problem is that this market has been spoiled for over 10 years with the generosity of the Federal Reserve's policies, meaning it's a cocaine-infused market. It's a cocaine addict. The valuations in the stock market are far divorced from corporate earnings, balance sheets, and even the growth prospects of these companies. The valuations are riding high based on the TINA argument, piling into the equities market because there is no alternative for investors. What does that mean? It means that the moment the cocaine operation gets reduced or pulled out of the market will suffer a withdrawal, just as in a drug addict who suffers a withdrawal when you take the drug away. This past week, the Federal Reserve came out and said, we recognize that inflation is rising higher than expectations, and therefore we're going to retire the term of not thinking about tapering and not thinking about raising interest rates, aka normalizing the monetary policy, to we're meeting to start talking about normalizing these policies. Oh, and by the way, we said we're not going to raise interest rates all the way till 2024. Well, now we're projecting that we're going to raise interest rates by 2023, and some Fed members believe that raising interest rates will happen as soon as 2022, meaning that tapering assets purchasing will happen way before 2022, because it usually precedes raising interest rates. Now, the viewers of this channel know ahead of time because I made a video a few weeks ago saying prepare yourself for a taper tantrum. Now, the Fed hasn't tapered yet, but the market is not stupid. The market always looks forward. And when the Fed says, hey, perhaps we're going to start raising interest rates as soon as 2022, that means that tapering is right around the corner. And the market started the taper tantrum right away. Now, we've already expected this, and I told you ahead of time, when the market moves into the taper tantrum mode, we will see the dollar index popping higher significantly, and that in return will crash the commodities market, at least metals, copper, gold, etc. That will also perhaps inflict some pain in the inflationary trade. And this is exactly what happened in this episode of the taper tantrum. What we did not anticipate is the following. We were anticipating that yields will pop higher, and the Nasdaq will crash further because tapering, meaning buying less bonds. When the Fed, the largest purchaser of bonds, tapers their purchasing program, bond prices go down and their yields go higher. But this is not what we saw, at least so far. What we saw is the opposite. So what's going on here? The mystery remains the reaction of the bonds market. And the question that every economist, market analyst, and expert on TV is trying to resolve is, what is the bond market trying to tell us? To attempt answering this question, we have to visit the issue of the yield curve first. Now, for all of you newbies who joined the stock market last year and you think that investing is so easy, all what you have to do is go to TikTok, get the ticker, log into your Robinhood account, and buy the stock, and boom, you become rich. You beat Wall Street. We're the future, bro. Think again, baby. It's not that easy. It's just that you happen to join the market in an insane bubble that makes the market so easy to invest in and trade. And in a hyper bull market, in a bubble market, everybody's a genius. All you have to do is pick a stock out of a hat, buy this stock, follow the crowd, and boom, you're making money. But stock market investing is more complicated than this. You gotta watch the macroeconomics. You got to watch the monetary policy, the fiscal policy, etc., etc. Not to mention, that thing we call corporate earnings, which nobody seems to follow these days. But it matters. The fundamentals always matter. Part of the fundamental analysis is the yield curve. Now, the yield curve is pretty much a representation of how much your investment will yield if you buy bonds across the yield curve. And by the way, they're not all bonds. Only the longer end, the 20 and 30, we call these bonds. And then the monthly to a year, we call these bills. And then in the middle of the yield curve, we call these notes. Just for all of you nerds who are going to go in the comments and say, oh, bro, they're not all bonds. Anyhow, the 10 to 30, we call these the long end of the yield curve. And then the monthly to a year, we call these the short end of the yield curve. And between the short end and the long end, that is the belly of the yield curve. Now, in a healthy economy, what you want to see is a steep yield curve. That means the 10-year treasury pays more than the 1 year, and the 30-year pays more than the 10-year. That makes sense, doesn't it? If you're going to hold a bond for 30 years, it should yield more than the 10-year. And a steep, healthy yield curve, by the way, the short end of the yield curve shouldn't dip into negative territory. That's not healthy. It should yield positive, but the yield should increase as you move through the yield curve. Now, what happens if the yield curve inverts? Meaning the short end pays more than the long end. We saw that back in 2019, by the way. Every time the yield curve has inverted, it preceded an economic recession. It is one of the most accurate indicators in the history of economics. Every time the yield curve has inverted, it accurately predicted an economic recession. Now, what happens if you move from a steep and healthy yield curve, like we're having right now, into a flattening yield curve, where the short end of the yield curve starts to rise higher, but the long end of the yield curve starts to move downward? And this is exactly what we started to see right after the Fed's decision on Wednesday. In this taper tantrum, at least Thursday and Friday so far, we saw the short end of the yield curve rising significantly higher. Meanwhile, the long end of the yield curve, the 10 to 30-year treasuries, moving downward. That is an indication, not for a recession, but for a slowdown in the economic growth outlook in the future. The market is trying to say, at least for now, that the near future will be prosperous, but as we move in the future, next year and beyond, perhaps the economic growth will slow down and the economy itself will start to dip into retraction. Now, this move, the flattening move of the yield curve, is not necessarily predicting anything about inflation. It is just predicting that the future will not be as bright as the near term. Now, some market watchers, and perhaps you guys are familiar with some of those, are translating the move so far in the yield curve as a prediction for an upcoming deflation, saying that inflation is transitory. Watch out here, because assuming that deflation is bad for economic growth is a major mistake. Remember, the last 10 years, we've been in deflation. At the same time, we had the longest bull run in the history of the stock market, and the economy started to thrive under deflation. So assuming that deflation is bad for economic growth is a huge mistake. Therefore, if this move in the yield curve sticks, and that is the key word, sticks, predicting that the economic growth will slow down in the future, and perhaps we have seen the best of the economic recovery and growth right now, at least in the near term. In my opinion, that is not an indicator for upcoming deflation. That is an indicator of an upcoming stagflation, when prices move too high, but economic activities and job creation slows down. Now, this is only my argument. I'm not the Messiah, and if you are interested in listening to an opposite view of mine, I highly recommend that you listen to David Rosenberg, who is one of my favorite economists, and I have personally learned from this man throughout the years. However, I have a disagreement with him. I held the same exact view with David Rosenberg last year, that this is a zombified economy hooked up on stimulus, and inflation will never happen because the fundamentals of the economy are not healthy. We're just putting a lipstick on a pig. And this is the view that David Rosenberg is holding right now. Now, I disagree with him because once inflation is born, it is extremely hard to put the genie back in the box. I have studied 400 years worth of inflation, going all the way back to Austria, Hungary, and the Russian Empire, etc. And you've never went from inflation, a transitory inflation, to deflation right away. Inflation has to work its way in the economy, and it starts very good, rewarding job creation. Everybody's having money, wages increase higher, but then you get the ugly side of inflation later on. It's like a tornado. In the beginning, you get a nice breeze, lots of rain, and then the tornado hits, creating all of that damage, and then it goes away. Inflation has to run its course in the economy. You cannot just get the good part, the juicy part in the beginning, and say, yeah, we'll pass on the bad and ugly part because we got the tools, bro. It doesn't work that way. Once inflation happens, it has to work its course inside the economy. And we are seeing this happening right now. For example, when wages rise higher in Chipotle and McDonald's, etc., and they hire employees, paying them $15 to $20 an hour. You're not going to go to the same employee a few months later and say, hey, we're sorry, we're going to have to reduce your wages back to $10 an hour because inflation was transitory. Your landlord is not going to reduce your rent because inflation is transitory. You're still going to pay the same rent, at least for the duration of the lease. Likewise, when companies raise prices on us consumers, and that price increase is received with tamed reaction from us consumers, meaning that we did not mind it, we paid the increase, and the demand did not get reduced. You think the same company is going to say, all right, we're just going to lower prices again because inflation was transitory? Of course not. They're going to keep the higher prices because consumer paid these prices and the demand did not go down. Therefore, I believe that the taper tantrum reaction that we saw the last couple of days, meaning Thursday and Friday, is an indication of two things. Number one, it is predicting stagflation to start to hit the economy. And we're already seeing that evident, for example, from the Philly Manufacturing Index, where the headline number is down, but prices paid continue to rise higher. The other explanation of the yield curve's reaction, the bonds market reaction, the taper tantrum, at least so far, is the fact that the market is complaining about tapering too soon. Remember, the market is a cocaine addict. It wants more and more and more, not less. The market is never going to celebrate when you say we're going to cut the cocaine. You will see a withdrawal, and this is exactly what we're seeing. The bond market is in tantrum mode, and it is saying if you taper as soon as we think you're going to start tapering, then the economic recovery and economic growth will slow down significantly once corporate America and the economy realizes that the Federal Reserve's support is being pulled from underneath the market. Now, if this is the correct explanation of the bonds market reaction after the Fed's decision, then it will be transitory. Because tantrums are transitory. The baby cries, throws a fit, and you have two options to shut the baby up. Number one, you give up to their demand. The baby continues to cry. It becomes annoying. And you say, here's your toy back. Here's the pacifier back. Just shut the fuck up already. Or you can do the other, perhaps the better reaction, the more mature reaction, so your kids don't become spoiled brats. And then all of us have to deal with them. You can say, you know what? Cry me a river. You gotta grow up. And the baby cries and cries louder and louder. And then when they realize that they're not getting the pacifier back, they stop crying and the tantrum is over. So is this exactly what we're seeing with the market right now? A few days of tantrum and then the reaction starts to normalize. And this is what we have to discuss in this video. What happens after the tantrum starts to subside? Let's visit the facts. Number one, the Fed did not taper yet. The Fed never announced any tapering so far. The market is just reading into what Jerome Powell said and what the dot plot is saying. Fact number two, inflation is still hot and inflation is still growing. In the meantime, this is good for the economy, not bad. Remember, the earlier stages of inflation are good for the economy until prices get too high. Perhaps we're already there. We're moving from the good part to the bad part, but we need more data. Tapering raises interest rates, it doesn't push them lower. If the Fed is the largest purchaser of bonds and the Fed starts to taper those purchases, then the rational reaction in the bond market should be yields popping higher, not crashing. So it all comes down to how far will the bond market, not the stock market, but the bond market looks forward to. Is it going to look in the near term where inflation is still growing and the economy is still recovering, or will it look way forward where the Fed starts tapering and raising interest rates to normalize the monetary policy? Looking in the near term is good. It means that yields should rise higher again, the inflationary rate should be back in favor, and traders buy the dip in the commodities market. But if the market decides to look a little further down the road in a future of tapering and raising interest rates, then at some point, yields will rise higher again. But this time around, the reaction of the stock market will be different, and we see more pain in the equities market because the Fed is going to pull the cocaine support from underneath the market. For now, the tantrum is pushing yields down, saying, hey, the tapering is happening too soon, and we need more support from the Fed. And in turn, what are the algos in the stock market doing? They look at yields are down, and they read this as a permission, a green light to rally the NASDAQ and the high multiple stocks higher. And therefore, I've been saying all week long, be careful and do not follow the knee-jerk reaction. Wait until the tantrum and the knee-jerk reaction is over. Because either way, whether the Fed tapers or doesn't taper, in the case of tapering, that will push yields higher. In the case of not tapering, that will allow inflation to rise even higher, and that will in turn push yields higher. And every single reaction you saw in the market perhaps will go 180. So you don't want to put yourself in this position. Wait till we see what the market decides to do, perhaps starting this week, when the tantrum reaction starts to cool down a little bit. Anyhow, this is my personal read of what happened in the market this week. Let's move on to cover the market performance on Friday. And here we go. The Dow Industrial Average closing in the red, down by 533.37 points, or a decline of 1.58%. The Nasdaq down by 130.97 points, or a decline of 0.92%. The SPY, the S&P 500, down by 55.41 points, or a decline of 1.31%. And take a look at the relative volume from the blue meter right next to the charts. It is unbelievable. the volume spiked significantly higher, meaning that there is conviction in Friday's market reaction. What about the sector's performance for the day? We're not going to give any medals because every single sector of the market closed in the red. Losses across the board. We have names to shame the laggards of the day, led by energy, utilities, and financials. What about the weekly picture? Again, underperformance across the board. Pretty much every single sector of the market closed in the red with losses, led by materials, energy, and financials. Bad week for the inflationary trade, that is the obvious. What about the advance to decline ratio? NYSE 16% advancing versus 82% declining. Wow. The NASDAQ 26% advancing versus 71% declining. And this is very important. A lot of viewers skip this part of the show, but this is extremely important. You saw the NASDAQ rallying higher on Thursday, but we looked under the hood and the advance to decline ratio was bad for the NASDAQ. I said, watch out, you could see a 180 right away. And this is exactly what we saw on Friday. So the advance to decline ratio is extremely important. But I know all what you want to hear is tickers. Give me tickers, bro. You got to grow up at some point. Moving on to futures. What's going on here? We saw a massacre on Thursday, and so far, we're not seeing massive rebounds right away, with the exception of grains. Grains rebounding significantly higher. Not recovering all the losses from Thursday's session, but close enough. And this is yet another indicator that this is a tantrum. Nothing has changed so far, and inflation is rising higher. The demand is still high for commodities, and perhaps we're going to see lots of dip buying once the US dollar starts to consolidate. Oh, and by the way, China manipulating the market lower, crashing the commodities market, specifically grains, and then what do you know? The moment grains futures became really cheap, specifically corn and soybeans, China started buying the dip aggressively. You want to talk about market manipulation? Here it is. They crash the market intentionally, and then they buy the dip aggressively to enjoy cheaper prices. What does that say? It says that the aggregate demand from China is still here. China is still interested in buying lots of grains, lots of copper, lots of other commodities, but perhaps they're waiting for better prices. And how convenient if they can crash the market creating better prices and then buying the dip right away. This is market manipulation pure and simple. We're not seeing a recovery in metals prices yet, but perhaps we'll start to see that as soon as the massive pop in the US dollar starts to cool down. That will perhaps happen as soon as this upcoming week. Moving on to the options market, the big casino. What else? AMC leading the day once again. And the volume is getting bigger and bigger and bigger. And this is impressive. And perhaps this is one of the biggest gamma squeezes that we have ever witnessed in the stock market. And that tells me that perhaps institutionals are also involved in this, perhaps leading the gamma squeeze higher. Because here it is, AMC number one with 1.8 million contracts. About 64% of those were calls. Folks, these are millions and millions of dollars being played in the options market for AMC every single day. Ask yourself a question. Are retail traders really have that much money? Gambling with millions and millions of dollars every week in the same name? I don't believe it. What about Apple at number two with about 1.3 million contracts? About 67% of those were calls. At number three, Tesla, the souffle. And the volume for the souffle is rising higher. What does that mean? There is more interest in buying these options. Buy them while they're still cheap. Oh, and about 1.1 million contracts traded for the souffle on Friday. About 55% of those were calls. What about the unusual activities that took place in the options market on Friday? We have some of those. How about we start with the ticker IWM? Lots of bets against this name. We saw $9 million being bet against the IWM Thursday. And now we have another one, $7 million betting against the IWM. By buying the 195 puts, expiration date July 30th, with expectations that the small caps ETF IWM will drop by more than 12% by then. They paid about $1.30 a piece to enter this trade. All in all, bringing the total to about $7 million. It's a big one. What about the ticker SPY, the S&P 500? They're also making a bearish bet here by buying the 345 puts, expiration date July 23rd, with expectations that the SPY will drop by over 17% by then. They paid about 80 cents apiece to enter this trade, all in all bringing the total to about $700,000. This looks, smells, and tastes like an insurance play. What about the ticker WISH, Wish? This is another meme stock, been going up and down impulsively. In this case, they're making a bullish bet by buying the 12.5 calls expiration date this upcoming Friday, June 25th, with expectations that the name will rise by more than 10% by then. They paid about 60 cents apiece to enter this trade. All in all, bringing the total to about $400,000. What about the ticker MGI, MoneyGram? They're making a bullish bet on this name, very interesting one by the way, by buying the 11 bucks calls expiration date July 16th, with expectations that the name will rise by more than 7.5% by then, and they paid about 80 cents apiece to enter this trade. All in all, bringing the total to about $400,000. What about the ticker STX for Seagate? They're making a bearish bet here by buying the 80 puts expiration date July 16th, with expectations that the name will drop by more than 6% by then. They paid about $1.30 apiece to enter this trade. All in all, bringing the total to about $650,000. I have a lot of other trades for you, but in the interest of time, we're skipping those. If you want them, get my premium subscription. I'm just kidding. I don't have a premium subscription. That's another scammer pretending to be me. Anyhow, moving on to the heat map analysis. And let's see what's going on here. And this is a weekly heat map, by the way. Right away, the picture is clear. Lots of pain for the inflationary trade. Financials, industrials, energy, materials, defensives, all getting whacked this week. They've been riding high because the Fed decided to let inflation loose. But what happens if the Fed starts to put a lid on this inflation by tapering? Not so good. Even though, in my opinion, it is an overreaction because, in the meantime, inflation is still rising higher and the Fed will start to taper gradually. And we haven't seen the fiscal spending yet. The tsunami of fiscal spending in infrastructure and the likes. We haven't seen that part yet. In addition, assume the Fed's taper, that will push yields higher, not lower, and therefore financials should appreciate higher. But once again, we talked about the technicals for this sector of the market, and I showed you names like Goldman Sachs, Caterpillar, Deere, Alcoa, all getting overextended by a lot and getting closer to a correction. This is the perfect excuse to start a correction in these names. On the other hand, the high multiple names, the tech names, rallying higher. Not all of them, just the mania part of the technology sector. For example, the more reasonably valued names, the likes of Intel, Texas, Taiwan, AMAT, Lam Research, IBM, Cisco, Oracle, VMware, all of these names got whacked significantly. And what overperformed was the high multiple names that usually appreciate when interest rates move lower, meaning that the move in these names, for the most part, was algorithmically triggered. We're talking about ServiceNow, we're talking about NVIDIA, we're talking about Square and Shopify, Palantir, DoorDash, Twilio, etc. The algos looked at the bonds market reaction and said, okay, I guess we're going to rally the high multiple mania names. In addition to the NASDAQ as a whole, buying the ETF, when you buy the ETF, the largest names in these ETFs catch a bid. We're talking about the big cap technology names, Apple, Microsoft, Amazon, Tesla, etc. Even though notable that Google and Facebook underperformed this week. As if the market's saying, we're rewarding the high multiple stocks and we're punishing the value names, even within the technology sector. Remember, when yields started to rally higher, Apple, Microsoft, Amazon suffered the bulk of the pain. But Google and Facebook actually started to rally higher, along with the value names, along with the inflationary trade. And now they're pulling back along with the same inflationary trade. Because as I explained to you before, two ways the market has to take. One has the inflationary stocks, the reopening stocks, and the value names. Another has the tech, high multiple, and stay-at-home stocks. This is how the algos read the market. They're dumb. They're very simple. You just have to understand how the algos operate. and I used to program these dumb algos. That's how I know how dumb they are. We are skipping the themes analysis in the interest of time because the theme is extremely clear. The inflationary trade is out of favor, at least for now. So we're moving on to the technical analysis, and right away the SPY 30 minutes chart. What happened here? A massive breakdown, leaving a huge gap, violating the support of 420 and even 417.30. The SPY tried throughout the day on Friday to recapture 417.30, and it failed to achieve that objective. And right away you see the massive rejection candle by the end of the day. So the safe bet here is that the SPY will be pulled back all the way to the support level of 412 and take it from there. But remember, it was a tantrum. We're not sure how yields and the dollar will react this upcoming week. If the dollar cools down, then we will see commodities pushing higher again, and therefore the inflationary stocks pushing higher again, perhaps yields normalizing, and therefore we see the financials also pushing higher, and therefore the SPY also holding ground steadily, because the SPY includes both the inflationary and the technology stocks in the market. And by the way, here's the weekly chart for the SPX, the cash index. The rising wedge pattern was broken to the upside, but since then, weeks ago, I've been calling this as a bull trap. Whether that will be proven correct or not, the point is, and I mentioned this back when I called this a bull trap, the SPY includes the inflationary stocks. The inflationary stocks are currently in favor, and so long as these inflationary stocks are in favor, the SPY is not going to go anywhere but higher. And I don't know what the catalyst would be to crash the inflationary trade, but whatever that might be, when it happens, the SPY will start to go down again. In this case, the SPX. What do you know? The catalyst that crashed the inflationary trade is the taper tantrum. And here's a 30 minutes chart for the continuous contract for the S&P 500. We talked about the line in the sand of 4,212.5. That was violated on Friday. And the moment you saw the flush down from that line, you knew right away it's going to be ugly for the S&P 500. And the main question for now is, where is the support? For that, we're moving on to the daily chart of the continuous contract. We know that the resistance is at 4,232. The support, we have some soft support at 4,120. But the strongest support goes down all the way to 3,960. And that will be a steep drop for the S&P 500 if it happens. For now, we know that the momentum indicators, the MACD and the RSI, are curling downward. Back to the negative divergence, back to creating red impressions on the histogram, indicating that the momentum is falling off the sky. As a matter of fact, the momentum is accelerating to the downside. If that is the case, then perhaps we will see another correction for the SPY, the S&P 500, all the way down to 3,960. For now, there is damage to the chart, but the bulls still have the advantage because we're trading closer to 4,232, the resistance level. What about the NASDAQ, the triple Qs? 30 minutes chart, looking a lot better than the SPY. The NASDAQ doesn't hold the inflationary stocks and the value stocks. It holds big cap technology names and the mania stocks of the market, the high valuation names. And therefore, it is faring a lot better due to the reaction in the bond market by pushing yields downward. For now, there's a semi-bear flag formation, not a significant one. We know that the resistance is 344.5. It was support. That support was broken. So the bears have a slight advantage, a very small advantage here, because we still have support at 340. So in the grand scheme of things, the big picture, which is the daily chart, the bulls have the advantage. But in the 30 minutes chart, the bears are starting to gain the advantage. Here's the daily chart, by the way, still going back and forth around the level of 14,000. Matter of fact, closing above that level. Is that bullish or bearish? Well, it's certainly not bearish, at least not for now. We have the momentum indicators, the MACD, the RSI, all in positive divergence, all trading in positive territory. So the momentum is still bullish for the NASDAQ. What about the IWM? Looking ugly here, very bad. Even when you thought that there is somewhat of a bottoming formation, that was followed right away with another nasty gap down, cracking below the very important support level of 223. Now, the chart is oversold from a 30 minutes perspective. Not by a lot, but that merits a bounce in the IWM if we see the reopening stocks catching a bid on Monday. But all in all, perhaps the reopening trade is over now and it should fall out of favor. This is exactly, at least, what the options market is saying. We saw massive bets against the IWM, $9 million in one day alone, and then on Friday, $7 million for one trade alone. Millions and millions of dollars being bet against the IWM in expectations that the reopening trade will fade away, and perhaps, this is the important one for the apes and the likes, perhaps the meme stock mania will also come to an end soon, because the two most important components of the IWM are the reopening and meme stocks. What about the rut? The daily chart breaking below 2,264, that gives the bears the advantage, but the chart all in all still consolidating within a range. 2,100 the support, 2,360 the resistance. And here it is, the chart of the week, the Dixie, the dollar index. Again, I have anticipating a pop in the dollar index if we get any hint of tapering from the Federal Reserve. This is exactly what we got, but the pop exceeded my expectations. I was expecting 92 at the top, max, but the dollar index closed above 92. But the move is becoming too extreme, at least from a daily chart perspective. The RSI reading is too high, the MACD is getting too steep, so perhaps we're getting very close to the top of the move in the US dollar, at least for now. Remember, the tapering did not happen yet. There is no tapering yet, but there are expectations that tapering will happen as soon as the third quarter of this year. But for now, it is print, baby print. They're still printing money out of thin air by the tune of over $120 billion a month in buying assets, let alone all of the other programs that the Federal Reserve has, let alone the upcoming tsunami of fiscal spending. That's not going to be good for the US dollar, at least in the short term. But this is what the taper tantrum looks like. What about gold? Whoa, what a nasty drop here. And remember, I've been saying, take profits in gold. Don't be too greedy because we're reaching a top here. What do you know? The gold chart is back all the way down at the level of 1750, where the pop has originated. This is a massive drop, a very steep one, by the tune of about 10% in a few days. Gold is oversold now. The US dollar is getting overbought. At some point very soon, we should see the reversal. The dollar going down and gold trading higher. Is it worth it to buy some gold right now, at least for a trade, for a pop higher? Yes, it is. And I bought some GLD calls on Friday. Again, there are no guarantees here, but I am following the technicals. And the technicals are saying perhaps gold is getting oversold and the US dollar is getting overbought. Here's another important chart, the second most important chart of the week, the 10-year Treasury yield. We saw the initial pop, which was the correct reaction from any anticipation of upcoming tapering. But then we saw the tantrum right away, reversing 180, and it's a massive flush all the way down to about 1.45%. Either this is anticipating upcoming stagflation and or saying that the Fed is tapering too soon. Anyhow, it's a tantrum. You think the market is going to like tapering at any time, whether it's too soon or too late. The market will never like tapering. The market is a cocaine addict. And now it is throwing a fit, crashing yields, saying, hey, Fed, by tapering now, you killed the prospects of economic growth in the next few years. Whether that's going to stick or not, that remains to be seen. I am skeptical of this move. I think yields will pop higher again. Because if the market is expecting tapering, the rational conclusion is yields will go higher as the Fed starts to cut these purchasing programs. What about the TLT weekly chart? Yields going down, bond prices going higher. No surprise here. We saw the higher highs, and now we have a new resistance level to watch out for, 149. The momentum indicators, the MACD, and the RSI are in positive divergence, and the positive momentum is strengthening. In addition, we have the possibility of triggering a short squeeze in the bond market. The TLT is heavily shorted. If for some reason a short squeeze is triggered in the TLT, we will see higher prices here, and yields will crash down further. So you have the technicals, the mechanics of the market versus the fundamentals. The fundamentals, if the Fed is about to taper, that pushes yields higher, not lower. But the technicals and the mechanics say if this move in the TLT continues to go higher and higher for a little while, that could trigger a short squeeze, pushing prices even higher and yields way lower than the readings we have right now. It's a battle between the different aspects of the tantrum, the technicals and the fundamentals. What about the VIX? What's going on here? A massive pop higher on Friday, closing above the very important level of 20. So for now, the positive momentum for the VIX is higher, not lower. We're seeing the launching pad here. If we have a few more ugly days in the SPY, the inflationary trade, the VIX can go all the way to the next resistance level of 25. And that will mean more pain for the SPY, the S&P 500. For now, we're watching how the VIX will hold the level of 20. If it doesn't hold 20, if it starts to slip as we start trading on Monday, you know that the tantrum is probably cooling off and the SPY will perhaps start trading higher again. But if the VIX opens higher, not significantly higher by the way, just a little higher above 20, then perhaps we will see more pain for the SPY. Now, assume that the VIX opens way higher, gapping higher, 25 or above, and the SPY gapping higher by a lot. That will perhaps be a bottom for now, at least for the SPY, and the top, at least for now, for the VIX. Moving on to Apple, the big kahuna, weekly chart. What's going on here? We have higher lows, but not higher highs. What does that mean? The chart is still in purgatory. Neither the bulls or the bears have the advantage. It doesn't mean that the chart is unhealthy. It just means that the chart is neutral for now. We have somewhat of strengthening in the MACD and the RSI indicators, the momentum indicators, that perhaps Apple will start to gain some momentum. And that could happen if yields continue to drive lower, because that will enable and give the green light for the NASDAQ and high multiple names. The algos will do that to pop higher. So we're watching the weekly chart, specifically watching the momentum indicators. If they start to turn positive again, specifically the MACD, then perhaps we will see higher highs for Apple. That means all-time highs for the name. We're still watching that possibility. But for now, looking under the hood, Apple is not looking so bad. Closing very close to what was support, now resistance of 131. Not a conclusive rejection yet from 131. You and I will know right away if this chart is turning bearish. If it starts to pull away from 131, going all the way down to 129, 128 at the most, and failing to keep that level. If 128, 129, let's say 128 and a half, the middle ground doesn't hold, then the chart will go down to the support level of 125. But for now, it is trading closer to 131. So the bulls still have the advantage from a 30 minutes chart perspective. What about Tesla, the souffle? This is a daily chart. The momentum indicators are still trading positive, and the chart is trading closer to the resistance level of 629, not closer to the support level of 540, meaning that the souffle bulls still have the advantage. And the real challenge this week is to watch the bonds market reaction. If the bonds market reaction continues, meaning yields going downward, you and I are going to have a decision to make. Do we follow the bonds market by buying the souffle, at least calls on the souffle, to break above 629? Or should we buy the dip in, say, Caterpillar, for example, which dropped significantly down in the last few days? And it has become an oversold stock, at least from a daily chart perspective. This is the dilemma that you and I are going to go through this upcoming week. Should we buy the dip, at least from an options trading perspective in Caterpillar, expecting a pop higher? Or should we go with the souffle and the high multiple names? And I believe that by Monday, we will know exactly which trade to follow. What about AMC? What's going on here? We talked about the ceiling of 60 to 65, the trading range. And it's all about options here. If we see heavy call options buying on Monday and Tuesday, and the stock starts to move higher as we get closer to the end of the week, Thursday and Friday, you see market makers panicking to buy the stock, and that causes a gamma squeeze higher. This is not what we saw this week. We saw lots of options buying, specifically call options, on Monday and Tuesday, but that did not enable the stock to trade higher, above 65, closer to 70 and 75. That would have triggered a gamma squeeze by the end of the week. What does that mean? It means that there are a lot of sellers too. Lots of these so-called apes, diamond hands, they're actually selling into strength, taking profits off the table. And therefore, we did not see market makers panicking to buy the stock on Thursday and Friday. And the question is, Are we seeing a double top formation? This is exactly what the apes don't want to see. If you're an ape, you don't want to see the double top formation. You want to see the stock trading above 60 once again by the beginning of the week. Watch the options volume Monday and Tuesday. If the options volume continues to be hot, specifically for call options, and the stock moves higher past 65, then that is an indicator that we're about to see a gamma squeeze by Thursday and Friday. Market makers will have to buy the stock once again. However, if we see the options volume being tamed and the chart pulling away to the downside from the very important level of 60, then that will trigger a tsunami of selling, because market makers will realize, wait a minute, the appetite of buying and holding AMC by the apes and the retail traders is perhaps fading away, and we have to start to dump the shares we're currently holding. Lastly, what about the tulip? The big one, BTC, Bitcoin. Still consolidating within range. We thought it was able to crack above 42,000. It was trading very close to 42,000, but pulling back, and now it is in the middle ground between the consolidation range, which is a huge consolidation range, by the way. 30,000 is the support, 42,000 is the resistance. But again, Bitcoin is extremely volatile, and therefore the range has to be extremely wide. We're trading in the middle ground now, so the bulls, the bears, it's a toss. The bulls had the advantage for a while, but they failed to crack above 42,000. Should we give the bears the advantage? Not really. We're still trading in the middle ground between the consolidation range. In addition, the momentum indicators are still positive. They're starting to lose some strength, but until that happens, the chart remains neutral. Moving on to the conclusion of this video. We don't have anything important on Monday on the economic calendar, but we have a lot of events throughout the week, with a lot of implications, by the way, on the bonds market. We know that the stock market will follow the bond market extremely closely. All of what we know for now is the head of the Fed, Jerome Powell, is playing games. He's not announcing tapering, but he's saying, hey, some of my members are predicting interest rates to start to rise higher by 2022 and 2023. That means that perhaps we're going to start tapering sooner, as soon as this year. He didn't say that, but he didn't have to. The market read that for him. And who's, by the way, predicting that interest rates will rise higher by 2022? My favorite two Fed presidents, Bob Kaplan of the Dallas Fed and James Bullard of the San Luis Federal Reserve. Now, when it comes to Kaplan, you give him a few shots and he'll get loose and spill the beans. That yes, inflation is getting out of control and we have to start raising interest rates way sooner than Papa Jerome is saying. The other one, Bullard, you give him a few puffs of hashish and he starts to get loose. And he got loose on Friday. And he said that he was one of the dots for saying that interest rates should rise higher starting 2022, meaning that inflation will get way beyond expectations and the tightening will have to happen way before expectations. The market did not like what Mr. Bullard said and it started to nosedive on Friday. The expectations are that this move will continue starting on Monday. But if we see a massive gap down in the morning, we have to look at the support levels, the technicals, and decide whether this will be a short-term bottom. Because this is a tantrum after all. It's a transitory reaction by definition. But until the dust settles, and we have more clarity to see what the market's final reaction is, I'm too hesitant to make big moves one way or the other. In my portfolio at least. I will follow the technicals via options trading, but my stock portfolio will remain the same. I've already hedged in anticipation of this move, and I made a video about it, the hedging strategies. Now, I want to hear from you. What are you doing in your own investing strategy? Are you pulling away from the inflationary trade and moving back to the NASDAQ? Are you buying the dip in the inflationary trade? Or are you moving to cash altogether? I'd love to hear from you, so leave a comment under this video and make sure you press the like button. Otherwise, I'll find you and I'll beat the shit out of you. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. Good night. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.